Okay, a critical mark, 19,286 is, where we shut shop in Monday's session. Right now, at least on the first tick, we're just about defending that mark and just trying to keep our head above water. But it's a very feeble start. Let's see whether we can, gain some strength here. The broader markets, of course, are seeing a better respite. The small cap index is now higher by over 1%. The mid cap index is holding out by about almost 0.5% or so. The big boys are supporting the market. Adani Enterprises, HDFC Bank, nearly a 1% move coming in there. Tata Steel, the big beaten down one from Monday, that also is seeing a bounce, as is the case with LTIM too, given how sharp the fall was on this stock in Monday's session. Let's also revisit some of the other names from Friday, the likes of an IndusInd Bank, which cracked about 2.5%. There was Tata Motors as well, which was a big drop. Similar was the case with most of the IT names as well. TCS, Wipro, they all fell pretty hard. L&T was down. And today you are seeing green on most of these names. Within the broader end of the market as well, Hindustan Copper, Laurus Labs, India Cements, these were big drags in the session. Now I want to address what the newsmakers are up to. Let's see what Torrent Pharma is up to. The India business revenue is up 18%. The US revenues, though, are below estimates, standing at about $30 million. Torrent Pharma holding up at 1,900 per share, 1.25% of an uptick coming in. Lupin, after them getting the US FDA nod for fluconazole tablets, the market size of about $43 million. Look out for that. Let's see what Reliance Industries is up to. Reports indicating that they may be nearing a deal to buy Disney's India operations. Very tempered move on Reliance Industries. Delta Corp, after the High Court asked the DGGST not to pass the final orders on the tax notice, 6% of a gap up coming in, all Delta Corp as we speak. And then PNB Housing should be reacting to its earnings as well. The gross NPA has seen a reduction all the way to 1.78%. There's also Ugro Capital. MK initiated a buy with a target price of 425. And on the flip side, of course, the disappointment has come in from Mahindra Logistics on its earnings, from SBI Card with regards to the new car additions, and then UPL and SRF as well, wherein the FMC yet again has slashed the 2023 guidance, and that's not going to spell good news for the sentiment on both UPL as well as SRF, although both of these stocks have started off mildly in the green as we speak. Kunal, just about holding on to 19,300. Any trades that are looking good?
Look out for defensive pack, and HUL would be the first stock in that category. Would look out for going on a contra buy for HUL, expecting the stock to bounce back towards at least another 100 to 150 points over the near term.
Okay, let's find out what Naresh makes of the market open. For now, it's stable, even within the broader universe, recouping some of those losses from Monday. What do you make, Naresh, of the markets at 19,320 levels, and what is your first trade?
So a decent pullback, at least in the mid cap and the small cap indices, would wait it out in terms of aggressively getting into long positions. But Hero MotoCorp at around 3140, 3160 looks interesting for a bounce back.
Get a move on then and bring on board Ravi Dharamshi, CIO at ValueQuest Investment Advisors. Taking forward this conversation is Nikunj. Nikunj?
So let's discuss market valuations, themes, and the recent bout of outperformance with Ravi Dharamshi of ValueQuest. Ravi, fantastic to have you back. Let's do a high five.
Thank you,
for the first time. Well, big picture with Ravi. We're calling this show as a differentiated show because Ravi's been a big supporter of ET now, and it gives me so much of pleasure, thrill, and excitement to see the investment journey of Ravi and his firm. It started with very humble beginnings to a powerhouse now. When we first met, I think the AUM was less than 100 crore. Today, you just add 2 zeros, 100 has become 10,000 crore. CAGR return absolutely fantastic. Market beating returns in terms of the quartile. So last couple of years, even though it's been full of twists and turns because of COVID and for markets and where macros have moved, I guess there is one firm which in a sense has really managed to navigate the waters. They have held out in terms of their thought process. And it's not about the size. I think it's the number of satisfied customers what ValueQuest in a sense today is commanding, and the respect they have within the investment community is fantastic. So Ravi, I remember our first interaction 2013, and from now to here, it's been 100x for the firm.
Yeah, thank you, Nikunj, for that introduction. I'm not a very superstitious fellow, but I do believe in maintaining the humility for the returns and the AUM growth that we have seen. All those kind of things get into your head, and that can be harmful for the future returns. So anyway, we'll pat ourselves on the back the day. Our job is to generate returns for the clients, and that's what we want to focus on. Everything else is just output of what we do.
Okay. 35% CAGR return, 35% plus CAGR return in last 3 years, 20% plus CAGR return. That means in the last 10 years, you've become 10x. If this 20% CAGR return continues in 20 years, you could become 100x. That's simple math.
That's
right?
mathematics. That's mathematics. I wish life was that simple.
But looking at the India appeal and the positioning of the market right now, 15 to 18% return for next 5 to 7 years, will that be a tall order?
So I'll put it this way. See, last 10 years, markets have thrown everything at us. From the currency crisis, from the global financial crisis, then came the currency crisis in 2013, then came GST, demonetization, IL&FS crisis, COVID. Everything has been thrown at us, and yet if we have generated 20% return, when index has generated about 12-13% kind of return, I think ensuing 10 years give a lot of hope of being better than what the last 10 years was. Last 10 years had a lot of asset quality correction. There was a lot of putting in place systems and processes at economy level, which kind of held back the growth. Also, there was a major move from informal economy to formal economy. So all that kind of contributed to the growth being lower in the last 10 years. I am very hopeful that the next 10 years growth for the economy and consequently for the markets also should be higher than whatever the last 10 years have produced.
If the starting point is today, which is 25th of October 2023, and if the end point is, let's say, 5 years out, 2028 October, are we in for CAGR mid-teen returns?
So this is what I'm telling clients, those who are incoming at this point of time, that if market does 10, you can expect some alpha from us. However, what I feel confident about is, or what I tell is that, in next 5 years, if we are to generate 15% CAGR, it will not be a straight line journey. Expect at least 10% kind of correction. Expect 30% correction. It's a given. We don't know what is going to cause it. We don't know when it will happen. But it's a given that these corrections are in the offing in the next 5 years, because last 3 years have been much smoother than they have been in the last 10 years.
You've got 3 categories: institutional investors, sovereign funds. It's remarkable that you're managing money for sovereign funds, touch wood. Then you got ultra HNIs, and then you got HNIs. Is the advice standard to all 3? Because everybody has a different time horizon and a different risk profile.
Yeah, no, so absolutely the advice is the larger institutional capital has far longer horizon, and their mandate is also different. The mandate is to outperform the market. It is not an absolute return, while for an HNI or a family office is more absolute return that matters. So from next 5 years, we feel confident about generating positive absolute return, and we feel confident about outperforming the index also. However, if we were to shorten that horizon to 1 year, then I'm not very sure about generating absolute return. There will be volatility along the way for sure.
Same time last year, on the same forum, you made a very loud call, which is that I'm getting out of IT, reducing my exposure to pharma, and I'm increasing my exposure to financials, manufacturing, and alternate energy. That call has worked. But in financials, some would argue that despite delivery, the gains have not been that spectacular.
No, I think that's absolutely correct observation. The financials, because one, there are many firms available, and this is an initial stage where all the boats are rising. So there is no differentiation between X versus Y. All of them are on an improving wicket. The problems in financial sectors come 3 years down the line to understand who has been aggressive in lending and who has been conservative in lending. So the differentiation probably will happen going forward. Currently, we are witnessing some pressure on the margins, which is also kind of holding back the kind of re-rating which we feel will happen in the financials as well. So I think the supply of paper is too much. There are so many NBFCs and microfinance institutions waiting to get listed, and so the supply of paper plus the no differentiation between firms is, I would say, is leading to overall the returns being still earnings oriented rather than there being any kind of a re-rating. So but I think we still maintain our positive view, because as long as the earnings are growing and the cycle is in favor, there is no reason for us to be getting out of the sector.
I look at financials and the retail growth is strong. I look at autos, the retail growth is poor. I look at rural economy, that is under stress. So banks are growing, and if retail lending is increasing, what end of the economy is growing? It cannot be only ultra HNI and HNI and urban consumption. For India to grow, retail, rural, and the semi-urban also has to grow. The banking data and the real economy data is telling me two different pictures.
No, you're absolutely right. It's been a very uneven recovery. And in our early stage post-COVID, it was a K-shaped recovery where the top end was doing well and the bottom end was not doing well. Some amount of revival we can foresee at this point of time at the bottom end of the pyramid because of the MSP price increases. Monsoons were bad, but they were not so bad as well. Just the pent-up demand in the rural economy. So some revival is going to happen, and you're absolutely right about that. So, and some amount of trickle-down effect also has to happen because of the kind of confidence in the corporate sector, the kind of investments being foreseen. That is eventually going to lead to job creation and going to lead to wage increase. In fact, we are already seeing in some sectors like manufacturing and financials where the war for the talent is getting very high-pitched, and the wages are rising in a tremendous way. So this will eventually hopefully manifest in other sectors as well. It's not as broad-based a recovery that ideally we would have liked. But I'm still a believer that the recovery at the bottom end of the pyramid is also up ahead, and it's not like it's not going to happen. The unevenness of the recovery will smoothen out over the next couple of years.
So in the terminology in which we often interact, इस मार्केट को डिवाइड करते हैं, सस्ता और अच्छा मगर सस्ता नहीं, and simple compounder. Divide the market in three parts for us.
No, yes, ability to find sasta or acha is definitely a challenge at this stage, and I would just add third dimension to it, which is the outlook, which is also what we focus on, is growth, valuations, and outlook. Which are the sectors which tick all three? There are very few in that. Some of the sectors that we have been bullish on. So financials definitely fall in the sector that takes the growth, valuations, as well as the outlook being good for the next 3 years.
Sasta, acha or growth?
Sasta, acha and growth. Okay. And outlook being good. So, and the second sector is manufacturing, where the tailwind is strong, manufacturing and capital goods. However, the valuations in the recent past have really kind of gone through the roof. So some amount of correction consolidation is warranted over there, but the outlook still continues to remain very, very strong, and these are long cycle plays. So I still believe that we are still in the early stages of the cycle. So a correction over there would be a great entry point at some point of time.
You made some investments in the manufacturing space.
Yeah, manufacturing has been a theme for us since a while. So has been energy transition, and so has been capital goods. And we have not had a capex upcycle since almost now more than 10 years. 2010-12 is where the previous cycle peaked. The gross capital formation in the economy is finally looking up. So that is the number one thing that gives us the confidence. And till now, it was only the central government which was kind of carrying the burden of capex. Now the state, this particular year, state government have also come in, and private sector has also come in. So all the three engines are going to fire going forward in the capex cycle. So yes, some of the valuations have gone up, but it is backed by growth in earnings and backed by growth in order book. It is not complete devoid of reality.
Ravi, what has differentiated your approach is that you're not obsessed with a P number. This is the right P, this is the wrong P. When a cycle is at play, you don't know where it will peak out. Could that be the feature or the hallmark of the boom in manufacturing or the upswing in defense or railways?
So, see, valuations are an art. They are not necessarily a PE number. PE number is a nice shorthand which we give ourselves to convince ourselves whether the company is expensive or cheap. However, you have to juxtapose it also with the kind of growth being witnessed and where are we in the cycle. So, if it is an early stage, early cycle, and also the PE multiple is looking more expensive because the earnings are on the lower side, then it is not the same where earnings are at a peak, margins are at a peak, and valuations is at a high, and the companies are probably taking leverage for that growth. Though that is condition that scares us. So right now the leverage is missing, earnings are more subdued. When I say subdued, it is not that we are still at the beginning of the cycle, right? What happened in the previous cycle from 2002 to 7, when we saw the capex cycle, we actually saw ROEs expand from 10-11% to almost 25%. We saw utilization levels go from 60 odd percent to about 85-90%. So the cycle is still ahead of us. The operating leverage is still ahead of us. The balance sheets are not leveraged. So that gives me, and growth is, again, as we mentioned earlier, it's not like all guns are firing in terms of growth. So there is still a lot of headroom available for growth, margin levers. Hence, valuation and taking the current P multiple and fretting about it can be injurious over a 3-5 year horizon. Again, I'm not saying that we cannot have a year of no performance or even for that matter absolute correction also in price. But from a 5 years perspective, it is definitely the earnings still have ability to surprise on the positive side.
Okay, I can understand that tailwind for manufacturing is strong, for energy transition is very strong because of the China plus one factor which is at play. But when it comes to defense, you have ownership in defense stocks. When it comes to railways, since you have ownership there, A, these are not high return businesses, and B, there's a binary risk which is elections. So as a portfolio manager, how would you manage that?
No, you are absolutely right. And as a disclaimer, we are probably trimming in some of those stocks as well, because the returns have been tremendous. And you're right, there is even though the hypothetical risk and probably smaller probability, but there is always a risk. If the new government comes in, the priority is probably likely to change. If there is a continuation of the dispensation, then probably there will be, in fact, even more thrust to the areas that we are witnessing in defense and railway. So reprioritization of the sector for the new government is a real risk that we are carrying. So some amount of taking money off the table is warranted at this juncture, I would definitely say. But from the quality of business perspective, I would say we are probably underestimating the size that these companies can become over a 3-5 year horizon. See, if India was to actually reduce its logistics cost from 12% to 13-14% to about 8%, which is what the global standard is, we'll probably need far more of railway logistics, and that will require far more capex into wagons and rakes and in the entire, which is what is happening, right? We have seen the eastern corridor of the DFC open up. We'll soon see the DFC on the western corridor also open up, and we'll see bullet trains and other electrification and signaling system. Everything is being invested into. And last budget was the first budget where we saw big absolute number as well as a huge percentage in terms of where the money is flowing towards. So I still believe it is still an early stage in the cycle, and these companies can become much larger from a 5-year perspective. So that is why it would be, and I have seen this pan out in multiple sectors, that if you are early in identifying a sector, stick around as long as the tailwind in the sectors are there.
Is that the secret sauce? Because if I historically look at the way you invested, you pretty much like to identify the trend early. Is that the differentiating factor for you?
So there are many ways to skin the cat. Some people buy cheap companies, some people buy cheap stocks. We try to identify which are the growth sectors, growth phase in a company, and then ride that growth phase. So we don't profess on buying companies for 10, 20, 30 years. Neither do we buy for less than 1 year also. So our focus is always on a rolling 3 to 5 years. And I think over there, if you can find a sector and then within that try and identify companies which can actually ride that trend well, is where our expertise lies to some extent. I would say that's what we have tried to do in the last 13 years. And yes, so these are the sectors where the outlook remains positive from 3 to 5 years view, and we'll continue holding that. We are not exiting. Some amount of taking money off the table is absolutely.
They say when there is cherry consensus, you don't get good prices. And defense, railways, manufacturing, ये घर-घर की कहानी हो गई है. Isn't that true?
घर-घर की कहानी तो नहीं बोल सकते, but yes, you are right. It's become more popular. It was an ignored sector probably 5 years back. These stocks were available at 8-10% kind of dividend yield, especially in the defense. Nobody was willing to look at railway. Railway used to be a kind of a seasonal trade where you buy it pre-budget and then sell it in budget. This time around the cycle has prolonged and it is way beyond budget because that change actually happened. See, whenever a new sector comes up, usually there are no dedicated sector analysts in the sell side broking firm. People don't know how to value it. People don't know how to estimate how much the growth can be. So all those things lead to a little bit of overvaluation. And I think that is, we have seen this happen in every sector that we have invested in. 2014-15, we identified chemical as a sector. Now today we are all, the stocks, they were available at single PE digit multiple. They went to 40, 50 PE multiple. The moment they are correcting to 30, now people are saying it's a buy. I mean, I'm not saying they are not a buy. In fact, we are not investing. But people have gotten so used to 40, 50 PE multiple that 30 looks like an opportunity to them. So again, that is what I would call a popularity, is that, sustained 6-7 year period, and then suddenly there are new companies coming for IPO in the same sector analysts, sell side brokerage, reports coming one after the another. So those are the things that point to, okay, everybody is now focused on this sector and money is flowing towards these sectors. So we are still in the early stages. Still there is no private sector in the defense. It is all PSU sector only. And at some point of time, some private sector companies will also come. We have seen 1-2 companies come to the market. We'll see many more companies come to the market to raise funds over here as well.
So is that a new idea, that buy private sector defense players?
No, so private sector, I think for the next 5 to 7 years, it will still remain a very much a PSU dominated sector. It is a strategic sector. Not everything will be opened up to private competition. However, there are spaces like whether it is drones or whether it is some other small equipment, subcomponents, assemblies, which can be addressed to by the private sectors. And yes, they are going to witness tremendous growth over the next 5-7 years also, but they are still all very small companies. The turnover ranging from somewhere between 50-100 crores to 500 crores is the range. So from a institutional perspective, there are still very small companies, but yes, that is a sector that should do well over the 10-year horizon as well.
Now, when defense started, there were no analysts, there was no coverage, there is no benchmark. But when consumer tech and fintech went public, there were a lot of analysts, a lot of reports, everyone had an opinion. Is that the reason why you avoided them? Because too much of research was available.
No, it's very simple for us. What we don't understand, we avoid. So the valuations over there were a little difficult to understand. We understand that those businesses are good, companies are good. We understand that there is a change that has happened in the Indian startup ecosystem where the companies are reaching a certain size and scale much sooner. A lot of it was also to do with the fact that money was available on tap from the VCP funds. And so the priority for every company was growth and not profitability. Those priorities have changed. The reality today is that everybody is now focused on becoming profitable. And the pitch to now all the PVC funds is we will reach profitability by X quarter or that X year. So that change has happened. But the good thing is for somebody like us is that, baby also gets thrown out with the bathwater. So the cash guzzling business models are finding it difficult to survive, but good companies also, which probably don't require so much capital for survival, but it is a growth capital that they need, are also finding it difficult to raise capital. So some of the companies that came to the market to raise capital are at a significant discount to the earlier valuation that were being discussed in late 21, early 22. So I think some semblance of reality has come in, and that is providing some opportunity in good business models for company, fund managers like us.
Ravi, unlike traditional investors who've always shied away from investing in IPO market, you've not done that. You've bought into recent IPOs, and this is again public information, so we can talk about it. Let's say Zaggle, the bulk deal data did indicate that you've bought into it. You made Keynes, another stock where you bought into public. So how come you've changed what the house always has believed in? Don't buy and invest in IPOs.
So see, market, I have learned from Rakesh Jhunjhunwala, there is one rule, there are no exceptions in this market. I mean, there are, you have to understand in an early cycle, in an early IPO cycle, there are some companies that come to the market which provide you that opportunity. If you see, the IPO market had actually dried up for almost 2 years. This was the first lot of the companies that is coming to the market. Yes, we understand the acronym, it's probably overpriced. No doubt about it. IPO's seller at the other end is an insider who understands the company and business very well, and buyer is somebody who's just a secondary market investor. So that mismatch is there. However, factoring in for that, if there is a good quality company, if we have mentally prepare ourselves that post listing, if the stock was to fall 20-30%, we will buy more. If that kind of mental preparation is there and that kind of commitment we give to a particular company, that is what gives us the comfort that we will build a position during IPO, post IPO also if required, if the stock corrects itself. So there are always exceptions available to the rule in everything. So I hate generalizations. I don't want to generalize everything. Like today, everybody is saying mid and small cap is overheated. It's a generalization. And can you not find companies within that basket of 500, 700 companies which can generate returns? Yes. For somebody who's like a big mutual fund manager, for him probably it's a big problem to move capital from one category to another category. And it is a reflection of the general state of that. But for a stock picker, for somebody who's specializes in identifying sectors and companies, it's okay. We understand that general bullishness is there in that space, but you can still identify your companies, and there will always be exceptions, and we focus on identifying those.
Ravi, over the years I've interacted with you, always admired Rakesh Jhunjhunwala. You've always admired Radhakishan Damani, but the house you represent also some of the finest investors, your elder brother Kalparaj. I never see you saying good things about him.
So he will hate speaking anything publicly about him. So I'm not going to say anything except that I have learned a lot from him.
Okay. I'm going to change gears now. I hope you'll appreciate that spirit of my question. But if one has to invest the value quest way for next 3 to 5 years, and someone who cannot, invest with you, size could be a constraint, your cutoff in terms of is a constraint. What is your way of investing over 3 to 5 years in terms of themes and sectors?
So we already touched upon it earlier in the show. Financials, manufacturing, energy transition are 3 themes which we believe have a strong tailwind, and they fall in the bucket of where the outlook remains strong. And financials in fact falls in the bucket of where the valuations also from a historical perspective remain very attractive. For manufacturing and capital goods, probably that's not the case. Some of the growth is already factored in. But the tailwinds are strong enough for us to say that any kind of a correction, serious correction would be an opportunity to buy. There are other sectors which fall in a kind of a different category, which is the consumer discretionary, where the outlook is actually very weak from the near-term perspective, and the valuations have not corrected much. But if the valuations were to correct over there because of the weakness in the sector over the next 2 quarters, that is one space that we are keeping on our radar, where we would like to pick some good quality companies.
But you're not taking a big cash call. You don't think market levels are such that you need to sit on very strong or high levels of cash?
So cash calls are very few and far in between. Last 13 years we have seen everything and we have not taken a major cash call. Usually what happens is when when I say we have trimmed a little bit of defense, railway and manufacturing, that automatically has created some cash. Now it's not a cash call on the market, but and that cash has been created and we are waiting for the next opportunity to show itself. So in some of the portfolios, in the older portfolios, we are sitting on probably 10-15% kind of cash. In the newer portfolios, we are sitting on almost 60-70% kind of cash. So again, this is just coincides with the market's overall, kind of exuberance level. So we will probably end up deploying as and when the market corrects itself.
So the fresh
or if the outlook changes.
So the fresh inflows, you're not looking, you are not in a hurry to deploy right now. You will stagger it.
Yeah, of course, absolutely. There is no, I mean, we don't follow a model portfolio where you have to, these are the set of stocks, deploy straight away. There are times when we have deployed on day one, whatever cash inflow comes in, and now these are times where you actually have to wait to find an opportunity. So, and hopefully the way the markets reacted on Monday will throw up some opportunities.
What else is keeping you busy?
No, nothing else. Markets and festive season is what's keeping us busy.
Not cricket?
Cricket season begins now. Yes, it will start now.
Just to wrap it up, one final point. India romance always has been consumers. If I look at the consumer per capita in India, it's at 2,500 crore. As India moves from 3.5 trillion to 5 trillion, 5 to 7, 7 to 10, well, there should be a massive uptick in the binge spending. How come you're not preparing your portfolio to capture that binge spending?
So as I mentioned earlier, we look at a 3 to 5 year horizon, and outlook in the near term for the consumer is not that great, as for the reasons we discussed earlier.
Not even niche consumers?
Of course. So we do have some presence in the consumption space as well, but that hockey stick growth that we are expecting has probably, it's still not begun, or it's actually probably going to be from category to category. We have seen some of it pan out for, say, building material companies, or we have seen some of it pan out for consumer electrical companies. But pure consumption, it's that move from $2,500 to $4,000 as it happens. The general buoyancy in the economy is still not being felt. It's not widespread. As you mentioned earlier, it's still restricted to some pockets. And that is why the overall consumer stocks are still not doing well. And there are some inflationary trends on the raw material side as well, which is kind of impacting the consumer stocks. But it remains a secular theme for us, and we will always be looking out for opportunities in that space.
Every time you come on the show, I'm going to do it live. I'm just going to open my Twitter and see if there are any questions coming, and I'm going to do it live. It's not a pretend. And there you go. Good to see Ravi Dharmesh on ET now. Before you wrap, Nikun sir, please ask for a tip.
I know that's a pretend. That's not live. The tip is, I think, see, a lot of people are scared of what's happening globally. Rightly so. I think US has probably put themselves in a corner because of the kind of fiscal deficit they have, and the kind of interest rates rise that we have seen in US is probably going to have its second order impact. There will be a recession and there will be a tough economic environment in US going forward. And this is coming on the back of a 13-14 years of fantastic stock market performance, where the margins are at peak also. So this is going to be a tough decade for US going forward. But India, on the other hand, is actually being very counter-cyclical. And so one end is US, second end is China, where China has probably shot itself in the foot, or probably their priorities lie elsewhere. Giving a boost to the capital markets does not seem to be their priority right now. They have other priorities. So that is leading to India being the other large market, which is now coming on the radar of a lot of people, lot of long-only funds, endowments funds, sovereign wealth funds. So I expect a lot of money to flow in. Historically, FIIs have owned as much as 25% of the entire equity of India. Today, that's hovering around 17%. So it's not like they are severely overweight or there is over ownership of FIIs in India. So I expect India to reach $5 trillion economy. I expect the corporate PAT to GDP to go from currently 4.1% to about 7-8% over the next 4-5 year horizon. If that happens, then it will be probably a $300 to $400 billion kind of a profit, corporate profit. And if I had to give it a 20 multiple what it is getting right now, it most likely will be a $6 to $7 trillion kind of a market cap. We are at about $3.7 trillion market cap. If India was to double its market cap, I'm sure we can find enough opportunities where we can go 3x to 5x in a 5-year horizon. I think any kind of a crisis in global markets which leads to selling in India will be a great point of entry point for Indian investors.
Before I wrap the show, it's a special show for me because they say 10 is a decade, and it's been over 10 years we've been interacting with Ravi. From an unknown, start to a unforgettable franchise. Last 10 years, I mean, Ravi, my sincere compliments. You've blossomed as an original thinker. I mean, what a franchise you've created with this kind of, whole investment approach. It's kudos to you. So it may not be a very special show for you, but it's a special show for me because we complete 10 years of interacting with you on ET now. So thank you very much. And my sincere compliments.
Thank you so much.
Sometimes you get thrilled, sometimes you get excited, but I think it's been a pleasure tracking your investment journey on ET now.
Thank you so much.
That's it on this edition of Market Makers. Thank you for tuning in. Thank you for watching the show.
In association with Magic Bricks, property sahi, services sabhi.
Babe, I love this apartment. Island kitchen.
लॉक करें?
और जब ये नया फ्लाईओवर बन जाएगा ना, मॉम एंड डैड will be just 20 minutes away.
तो परफेक्ट नहीं है घर.
इसीलिए housing.com with maximum properties. Housing.com पर से perfect.
Back with first trades, Dietune 80 now, and the first trades are settling in okay. We are managing to cling on to that 19,300 print so far at least. You've got metals staging a comeback, beaten down IT names like an LTIM holding out well, Hindalco, Tata Steel, JSW Steel, Adani Ports, Kotak Bank. They are the ones which are actually leading the list of winners from within the large caps. Within the broader end of the market, there's L&T Finance, Jindal Steel, Indiabulls Housing. Delta Corp is now sitting at a gap-up move of 5.6% and clinging on to its opening gains. And then, of course, there's Balrampur Chini as well, which is holding tall by about 4%. But still in the thick of earnings, let's address another set, PNB Housing. We've got Girish Kuski, the MD and CEO, joining in on the show right now. Girish, hi, morning. Good to have you on the show. You've posted retail loan growth of about 12% in the second quarter, as opposed to 11% in the first quarter. Are you still sticking by with your 17 to 18% growth guidance?
Good morning, Aisha. I think we had a very good quarter two. We stick to our book growth guidance of 17 to 18%. So as I had mentioned earlier, first we will catch up with disbursement and then the book growth would follow. If you look at quarter two, obviously, on retail, the growth is about 18% on disbursements. And not just on disbursement, even the logins were about 31%, sanctions up 30% on a YOY basis. So we stick to our guidance of both disbursement, which is 22+% growth over last year, and book growth of 17 to 18%.
Yeah, that. The highlight of your second quarter, I think, was the resolution of a major NPA account worth about 784 crore rupees. From here on, where is the asset quality headed then?
I think if you look back in last 1 year, the GNPA was about a little over 6%. Now it is 1.78. So as I had mentioned earlier, every quarter we will see improvement in asset quality, both on retail and corporate. Now corporate is now almost done. We have just one account, which is about 68 crores. So corporate, which used to be about 33% GNPA, is now down to less than 3%. And on retail, now it is 1.74. So I think going forward, every quarter we will see improvement on the asset quality. Maybe in next 3 to 4 quarters time, we would like to be one of the best and comparable in the entire housing finance industry on the asset quality.
I wanted to also understand whether or not you're taking additional write-offs in the second half from the reversal in provisions like you did in Q2?
I think largely our strategy has been to work on actual collections in terms of cash and settlements. However, since we had resolved one large corporate account in quarter two, and therefore we had to write back, so we thought we would strengthen the balance sheet, and therefore we had technically written off. So I think our focus in future also would be in terms of reducing GNPA. Largely the focus would be on collections, but if there is a need, I think we can always look at it.
Okay, fair enough. And what are typically the yields that you charge in affordable housing?
I think for us, affordable is a great story. I think it's now 8 months that we started. We have reached a book of 750 crores, and very shortly we will hit 1,000 crore mark, and probably will be one of the fastest to reach a book of 1,000 crores. We are seeing a lot of traction on affordable. I think every quarter we are seeing disbursement growth of about 65%. So there is a good story which will pan out for us going forward.
Cost of funds, Girish, you think they've peaked out for you? And do you think that, given the potential credit upgrade and, of course, possibility of eligible for low-cost NHB borrowings as well?
Oh, yes, I think this year we are eligible. We are working with NHB for funds. So that would come in, and obviously the cost would go down from the current level.
And what's the NIMS trajectory that you expect given this outlook?
I think on cost of funds, I think it is almost flattened. Now we are at about 7.99% on cost of funds. So there could be little reduction from the current level. I think by and large, our focus is to build more profitable book. We do two types of business. One is prime and second is affordable. On prime, we are slowly moving towards more profitable book building. On affordable, anyway, it's been a great story. On the corporate side, it was a conscious call to degrow the book till we resolve and then restart. So I think restart is now, I think very soon we'll be able to restart in about, let's say, 2 to 3 quarters time.
So what is the long-term growth target when it comes to corporate lending?
No, I think corporate, we would always do business more from a strategic point of view. The idea of corporate is that, when we restart, we will be focusing on select developers, select projects in select locations. We would focus only on construction finance with a retail linkage. So the idea of doing corporate is more to enable retail growth.
Okay, fair enough. And what would be the outlook on your loan mix? How is that going to evolve between prime, affordable, and the corporate lending segments?
So, in fact, I had mentioned this earlier, incrementally by this year end, we'll be able to reach about 10% of disbursements coming in from affordable. We are already at about 9%. I think we might reach the 10%. So affordable would grow at a much faster pace compared to prime. I think incrementally, we should get to a stage of about, let's say, 60 to 40%, 60 from prime and 40 from affordable. But of course, this will take time because given the ticket size on affordable and the effort which needs to build up affordable, it will take time. But I think that is the mix what we are looking at. If we look at the overall portfolio, when we restart corporate, and corporate at its peak would always be less than 10%. And out of the rest, I think ideally we would like to reach 60% on prime and 40% on affordable.
All right, good to have you on board. Thank you for walking us through your growth targets as well as outlook. So 17 to 18% retail loan growth guidance and talking about how the corporate NPAs have declined to less than 3%. PNB Housing just about breaking into the green at 716. Time for a very quick break then right here on the show. Stay with us for lots more corporate voices, chart busters and stocks on the move.
Okay, staying with the equity markets, here's a word coming in from Nilesh Shah, MD and CEO at Envision Capital, talking about his market outlook across sectors and sharing with us his top ideas as well.
Of course, we continue to hold a relatively a focused portfolio, but it's a portfolio across sectors. And we have been liking names around capital goods, around defense, around auto components, the tier 2 banks, very specialized players in the financial space, which is online broking, online insurance. These are the kind of businesses that we have been owning. Also, our exposure to alcoholic beverages, we think that's a standout sector from a 5 to 10 year perspective. So that's the space that we have been kind of very, very positive about. Most recently, though, a lot of our new investments have been into, more the technology space. I have earlier talked about the exposure that we've had to MapMy India, which is C Info Systems. NewGen is a company that we have liked and we've owned. They came out with some stellar numbers. One of our most recent additions has been a small IT services company called Datamatics. We clearly believe that in the case of Datamatics, they seem to be on a path of higher growth. They have reorganized their businesses, largely focused around digital and artificial intelligence, which I think will provide strong tailwinds for them to grow at an industry-beating pace. They probably still have some bit of margins to expand. They're trying to build an interesting products portfolio, which might kind of result into slightly non-linear growth going forward. And valuations are attractive. It probably trades in mid-teens in terms of trailing earnings basis. So I clearly believe that there are a whole bunch of sectors which we've continued to kind of be very positive about. But off late, it's just coincidental that some of our most recent investments continue to be around the technology space.
We had a conversation, Nilesh, which was centered around the fact that you need to buy specialized IT companies. I mean, you buy a SaaS company, you buy a company which essentially is giving more services rather than just IT services. So if that theme has to be applied, one is Datamatics, what else?
Datamatics is there. NewGen is there. I think that's again, they've announced their results very recently and they came out with some stellar numbers, business growing like kind of in the 20s, which I think is quite phenomenal. We continue to like LTTS, though they have cut the revenue guidance, but I still believe that in this current environment, if a company is talking of growing at 17-18%, which is high teens, and sustaining margins at 18% in terms of EBIT margins, and it's got a phenomenal size. I mean, it's now almost a 45,000 crore market cap company. So to that extent, it's not like kind of some small company out there. These are the kind of spaces. If I look at each of these companies, they represent very specialized space. I mean, L&T is basically an exposure to the ER&D space. They keep working on software-defined vehicles, the whole transportation, mobility space, semicon. That's the kind of space that they've focused quite a lot on. NewGen is again a very specialized products company focused more on the BFSI space, largely focused on India and Asia, but now trying to kind of make a dent or a headway into the US and Europe markets, which creates solid tailwinds. They seem to have a lot of wind in the tail, wind on the back, which is helping them to grow. So these are some really nice kind of opportunities which are there. And on top of that, MapMy India, which is more a domestic business, but clearly like the business that they run in terms of digital mapping solutions, in terms of IoT-led navigation solutions, artificial intelligence, drones technology for the future. The number of use cases which they can have probably can be quite phenomenal. So it's an opportunity which I think is like kind of probably spans across the next 5-10 years. Obviously, each of these businesses runs risks of competition or disruption and volatility in the external environment. These are the kind of risks and challenges which most businesses do face. I don't think there are exceptions to that. But on the whole, on the balance, I think these are nice businesses to own from a medium to long-term perspective.
Between 1st of Jan and 18th of October, have your top 3 holdings or top 5 holdings changed?
Not very materially, Nikunj. Not very materially. I still think we continue to own, the likes of Radico Khaitan, Angel One, PB Fintech, Mahindra Holidays. These have been some of our leading holdings. And Polycab. These are some of our holdings which we have continued to own. And we have not made any material change in any of these holdings.
Okay, now liquor, or when it comes to buying the entire liquor space, some would say that, look, it's very simple. India will consume more. India will grow more. Per capita will grow. Now, that's a lovely macro thesis. But frankly, if I look at some of the liquor companies, they've had a lot of volatility in their numbers. They get impacted because of raw material. Growth is always in mid-teens. Even though we are looking at a complete change in terms of consumption pattern changes, market cap changes, and per capita changes, liquor companies are mediocre growth businesses. What gives you the conviction to buy a mediocre growth sector then?
So Nikunj, I think, and my view is slightly more long-term. that probably for the next 5 or 10 years, I see liquor companies being able to kind of grow at maybe 15 to 20% on an annualized basis. There could be a few years, few quarters maybe where the growth may be slightly lower than that, but I probably think on a very 5 or a 10-year perspective, they have enough tailwinds to grow at 15 to 20%.
All right, that's the take coming in from market experts, but let's map out what's going on in the markets at present and get in some chartbuster ideas. For now, languishing around the 19,290 mark, so sub the 19,300 mark. It's quiet when it comes to the mid-cap index, but mind you, the small-cap index is anything but quiet. You've got a smart gain, so sort of recouping those losses from Monday. As we speak, it's up about 0.7%, and within that space, something like a Sri Renuka, Delta Corp, Triveni Engineering, Balrampur Chini, NBCC, City Union Bank, they're all abuzz. Let's get straight then to our chartists to identify their chartbuster calls. Kunal and Naresh joining right back in. Kunal, your chartbuster call?
Thank you, Avan, for that. So today's chart which I've highlighted is a chart on GAIL. Now, another PSU name which slowly and steadily has given a breakout. But more interestingly, I think the propensity of the chart patterns to come back towards a major support point is very important. So again, no exception that this stock has also gone through a correction the last couple of days. But what matters is that whether the stock replicates a similar kind of a tendency of bouncing off from its crucial or major support levels. So what we've looked out for, the charts for GAIL is over the last 8 to 9 months, where the stock has been consistently making a pattern of higher highs and higher lows. As you can see, that the stock has been consistently making higher highs for itself, which is a strong indication that a stronger trend is in force for the stock price. Now, from the recent lows in the month of June, July, when the stock was at 100, 105 levels, as you can see that the stock has been adhering to this major trendline support. So 105 was the first base for the stock in the month of end of June. This was the next base, which was higher at 110. And now we are at a point where the stock is trying to form a base at this 120 mark. But the third and the most important aspect is that in the historical last 8-9 months, there have been many phases when the stock has gone through a sharp phase of correction. So as you can see, 3-4 consecutive days where the stock has sold off. It forms a base after the sell-off, which remains to be a major support, and then the stock gets into a rebuilding of a trend rally. I'm expecting something very similar this time around for GAIL. The stock forming such a kind of a sharp correction. I would expect this to be a major base for the stock price. So closer to 120 mark could be a classic risk reward to buy the stock for a potential target of 130 to 135 plus in the next 2 to 3 months.
Right, okay. Naresh, what's the chartbuster that you're identifying?
So that's a chart for Titan, which has done really well over the last 6 months. From the low of 2300, 2500, the stock scaled up to 3300 levels. It's made a possible double top formation around that 3300, 3330 mark. The recent, support comes around that 3200 mark, which was also the previous high. A break below 3200 is an indication that a short-term reversal could be in play. So out here, it's a sell on rise with a stop loss at 3300 and a target price of 3000 to 2800 in the short term.
All right, let's nail it down to those individual stock calls then. And Kunal, what's popping up on your radar?
So L&T Finance is something which I recommended on Friday. The stock apparently has been doing quite okay in the last 2 days of correction as well. So would retrade a buy on L&T Finance, targets at 145, stop loss 133. And the second would be buy on City Union Bank. That stock is also looking quite strong at 132 plus levels. So would suggest a buy with 145 as a target, stop loss at 128.
Right. Naresh, let's have your stock strategies too.
So 2 large caps. First is the buy on Dr. Reddy's, showing the latest trend, stop loss at 5500, target price of 5900. Second is a buy on Hero MotoCorp, a dip here, giving a risk reward opportunity, stop loss at 3100, target price of 3400.
Right, let's move on and let's address another set of earnings. We have with us K. Srinivasan, the MD at Kirloskar Pneumatic, joining in on the show right now. Mr. Srinivasan, good to have you on the show. Just going through your numbers, your Q2 revenues was impacted on a year-on-year basis, I guess, owing to the slow offtake of CNG packages and also low export orders. Tell me, how are the early trends for the third quarter looking like? And then would second half be better than the first half?
Yeah, good morning to all of you. Thanks for having us here. I think H1 was muted due to 2 reasons. One is we couldn't execute on the CNG packages because while we had orders, the sites were not ready, so clearances were just not there. And export is also down by about 40 crores compared to last year. Primarily, gas packages going into the Middle East were delayed. H2 looks good because in the H1, we had about 850 crores of order booking, which is something like 65% higher than the corresponding period last year. We expect a very accelerated execution in H2, and even giving for the CNG packages not going to plan, we would still have other things that will cover up. So we expect still to deliver double-digit growth for the year.
Okay. Small changes. When you look at the narrative from the government, for example, what the Delhi government has said in terms of adoption of EV, given that India has some of the most polluted cities in the world, do you think other states could also follow this kind of a path and that could have impact on your business?
The gas burning engines are probably far cleaner than anything else that is available. So we must take it carefully. If you look at the government stated policy that as they've been putting out more GAs being given out for PNA RGB, the 12th round of bidding has been completed. They would like to bring in CNG or gas right across the country. The announced government principle is that the energy basket would have about 12% of gas compared to the current less than 6%. So gas being used more across the geographies is a given. Now, you cannot have gas at homes if you do not have the commercial gas being available for vehicles, because one, in a way, cross-subsidizes the other. So I think we must take all this carefully. I still believe that the government's overall policy of having a larger percentage of gas in the energy basket is more sustainable, and this is what it is likely to be. The announced increase in CNG stations across India is from 5,000 to 10,000 in the next 5 years, and this will happen. So we'll have to take announcements in Delhi, etc., step by step.
Given is on the oil and gas sector, and just wanted to know, given the kind of conflict that we're seeing play out in Israel-Hamas, are you seeing any disruption, any potential disruption perhaps that's anticipated when it comes to the ordering activity or the momentum from the Middle East?
Middle East is definitely going to see some slowing down of finalization or even execution of orders. Mercifully for us, we don't have any big orders for execution in Middle East for the next 6 months. We are negotiating orders for the next year, and these would all probably take a little more time than normal. The next 6 months for us is going to be largely driven by projects in India. And here we see accelerated interest in going for ammonia terminals, ammonia plants for fertilizer. As you're all aware, Government of India has more or less made an announcement that they would like to reduce or phase out urea import by 2025, which means more ammonia terminals, more ammonia plants, large projects in this space will be keeping us very busy for the next 12 months.
Fair enough. That's with respect to the situation in the Middle East. But back home, the Delhi EV policy as well that came up last week, where 100% of the aggregators will have to move to EV by the year 2030. Are there any concerns that demand for applications in that space will be impacted?
Like I answered earlier, yes, this is an announcement. We'll have to wait and watch how this plays out eventually. There is also equally strong move from the government to move a larger percentage of the energy to the gas basket. And that's also something that will have to play out. So let's see how it moves.
Do you think the Middle East business will come back?
It's going to take some time. It's too early to talk about it because there are orders that's being still given out. Like I said, LNG and oil from Middle East is still very important for Europe. It is not something that's going to disappear altogether. But new projects will definitely take more time than earlier.
Understanding of how many ICE engines will be ICE engine is the wrong terminology. How many diesel-driven engines would actually be converting into CNG kits? ICE and EV is separate. I apologize. I'm talking about the change of fuel here, not the change of the engine mechanics.
So I think the move from diesel to gas is something that's pretty much happening, and that will only accelerate. Gas is definitely cleaner than the diesel engines, and this is also more efficient. So this is clearly something that is happening. And there the technology is proven. People have accepted it as less polluting. And so this is something that is happening as we speak, and this is something that will accelerate, because you must also understand that the households in India still are in the process of moving to natural gas in a significant way across India. And that would also mean that you need to have the gas pipelines, and then it makes sense to have this distribution also available for the vehicle. So this is a move that will continue. Now, what we did hear about the Delhi government is something we'll have to see how it plays out. Early days.
So at a time when you think that it will be hard for you to call out the real recovery process for next 2 or 3 quarters, then how do you think the capex and utilization rates would move? Are you committed to your capex, or are you likely to withdraw it? If your utilization rates they go down, could that have an impact on the aggregate margins?
We have not committed a large capex. We are only doing a value chain integration. We are getting a forging plant, fabrications ready, which will allow us speed of execution and also be more competitive. That capex is a small amount, less than about 50 odd crores. We will complete it. Like I said, first 6 months order booking has been a record, 65% higher than last year, and largely for domestic orders. A significant part of the orders that we are getting in are India orders. And these are also, I would even go to the extent of saying, largely government-driven orders. This will continue. I don't see any slowing down on this. It's in fact accelerating. India is a good space to be in today, and we are doing well in this space. So next 12 to 16 months or 18 months, we're not too worried. But we also realized to maintain the growth momentum, 20% plus, we would need to have these Middle East and Southeast Asian orders coming in. And there we see some slowing down. And that will happen. We can't avoid it with so many wars happening. But the India story remains very, very strong. And that's a good thing. I should just add here one thing. We are all in what is called as a capital goods sector. This sector is still half and half domestic, half imports. As we go forward, a significant part of these imports would get converted to local manufacture. So for us who are in the capital goods sector in India, we see a good chance for using this downturn to see how we can accelerate and get a larger share of the Indian market itself. So I don't see a slackening, at least for the next couple of years.
Appreciate your time. Thank you for joining in on ET Now and giving us more clarity on how things are shaping up domestically, the export situation and business as well. We'll take a very short break with news that currently the index is at 19,300. Be right back.